Good morning, everyone. My name is Timothy Lee, and I'm a mining analyst here at Red Cloud Securities. We welcome Rohan Hazelton, President and CEO of NorZinc Limited. He will speak to us about NorZinc's high-grade and advanced Prairie Creek development project in the Northwest Territories of Canada. Rohan, you have 15 minutes, and then we'll have a 5-minute Q&A at the end of the session. Attendees, please feel free to ask questions using the Q&A link below. Take it away, Rohan.
Great, thanks, Tim, and thanks everyone for joining and being here. I'll give a brief overview of the project for those who aren't familiar, and as well as an update for those that have already been following the story. As Tim mentioned, we're developing the Prairie Creek mine, a high-grade zinc, lead, silver deposit mine in the Northwest Territories. I'll be following the same presentation that's up on our website and been shared before, but I'll skip over some slides to keep us on time. Just a quick overview for those who aren't as familiar. This is a very high grade zinc, lead, silver project. Grades some of the highest undeveloped grades in the world, and certainly in Canada, with a project plan of a 2,400 ton per day mine over a 20-year mine life. We're located in the southwestern part of the NWT, with strong support from local communities that are primarily Indigenous and First Nations communities in the area, as well as territorial support. We do have a strong team and board, as well as strong supporter in RCF as a 49% shareholder in NorZinc, as well as a strong plan for responsible mining, and we're really the nearest term next project in the NWT, with planned production for the end of 2025. A little bit more detail, first of all, on the right, and other photos that you'll find on our website of our existing infrastructure. This was all built to a 90% completion by the prior owners almost 40 or over 40 years ago in the early 1980s, and we have 1,000 ton per day existing plant and other infrastructure, as well as very importantly 5 kilometers of underground workings that we can leverage in order to bring this mine, and I don't want to say back into production, because it was never in production. It was all opened up and almost ready to begin production before a metal price decline, and it was mothballed again back in the early 80s. Right now, today, it's a mineral resource inventory of almost 17 million tons at grades depending on what metal price ratios. Zinc equivalent of 23, 24, even 25% zinc equivalent. With 3 main ore body types: main quartz vein, stratabound massive sulfides, and stockworks. In October and November, we published results in the full study of an updated PEA showing a 20-year mine plan and an NPV of $300 million US, as compared to the original feasibility study from 2017, over a 1,600 ton per day mine plan. And again, you can see in the bottom picture on the right, it's a very small physical footprint, and we've also designed a very small environmental footprint in terms of our approach to mining, with 100% paste and backfill back into the underground, no tailings, and we will be refurbishing and using what the holding pond that was originally designed as a tailings pond. We'll be using that for water treatment and 100% water recycling out of the mill. Just on a grade comparison to a number of other projects on a zinc equivalent basis, with showing the strength of Prairie Creek project in the first bar to the left. Just some high level results from the PEA that we announced in October. As mentioned, an NPV at 8% of $300 million US, and that's at $1.20 per pound zinc. We showed some sensitivity at $1.50 per pound zinc, which would be almost $500 million in NPV. and that's as compared to just over 30 million Canadian market cap right now today. And of course, from a metal price point of view, zinc, I think today is about the same price as unleaded gasoline at the pumps, over $1.80. Over a mine life using global resources of 20 years, about half of that, just over half in measured and indicated, and then annual, operating cash flow or EBITDA, north of 100 million US, and on a free cash flow basis, north of 60 million US, which very strong cash flows that can lead to very strong project financing plan, and on the low cost end of the cost curve on a byproduct basis with C1 cash costs of 19 cents per pound, and with an all-in sustaining, or not all-in sustaining, but with a C3 cost, fully loading with initial capital cost in the 60 to 70 cents per pound range. And here you can see the various components of revenue and expenses over the proposed life of the project. And again, there's a lot more detail in our published 43-101. Just turning to the planned production per the PEA in terms of payable zinc, lead, and silver. And I think one very important point to point out is the strength of the silver component in this project at about 2.4 to almost 3 million ounces of silver a year, which lends the project well to very likely to a strong silver stream component as far as an overall project financing. From a revenue point of view, revenue is approximately net revenue is approximately just under 50% zinc, 30% lead, and 20% silver. But again, in terms of metal, metal production, that's still a very strong silver component. Just in terms of total resource, which is summarized below, you can see there's still significant exploration potential at the mine, and this is the current resources, the measured in red, indicated in green, and inferred in blue, over strike length of just over 2 kilometers. And there's been very little exploration this is to the north. It's the dips to the north, with one drill hole done 2 kilometers to the north and almost 2 kilometers along strike, which produced very similar grade results and more importantly very similar mineralogy and stratigraphy, and we certainly see the very, very high potential for this once the mine is in production to be able to continue along strike and down dip to further extend the mine life, as well as there are other resources that have been drilled in the past to the south of Prairie Creek, although with a little less in terms of volume. But really today, this is not so much. There's a significant exploration and expansion story, but this is mainly about getting this mine into production as efficiently as possible. And the key to doing so, the key to unlocking the schedule and the value, is really the access road. It is a remote mine and requires a 170-kilometer access road. It was originally, when the original equipment that you've seen was brought in, it was brought in on 2 winter road campaigns. That those have all grown over mostly to today. We've been studying the optimal alignment, and we have a plan for an all-season access road, which we built over 3 winters and 2 summer campaigns. The initial winter road construction that we call Pioneer Winter Road would be the first campaign at the end of this year into 23, and that's primarily aimed at clearing the trail and doing the geotechnical work required to be able to do the full design for the full all-season road. So following that would be two full-blown winter roads that would be robust enough to bring in something along the lines of 700 to 800 loads of equipment, which would be used to expand and refurbish the surface infrastructure, as well as mining equipment to get in and begin the mining. And that would be over the 2 winters. That's the red triangles shown there is the equipment being brought in, as well as 2 summer campaigns to build a year-round all season road. So the road is really the key to the schedule. That's what makes this closer to a 3-year project, turning to kind of the overall schedule. If once the equipment is brought in terms of work being done on site surface and site infrastructure and process plant, as well as the mine, that would really be closer to an 18 to 24 month project. Once we've brought in the initial road access, we will be working this year. Key goals are on de-risking the project. We had some permitting delays at the end of last year. We're quite disappointed by that. And we are working to ensure that we complete all of the permitting requirements required for that winter road during the end of this quarter and into Q2, as well as continue to progress and ultimately receive by likely the middle or late Q2 the expanded mine permit for the expanded mine plan of 2,400 tons per day. And then also working on a summer works campaign, aimed at upgrading some of the infrastructure on site, as well as additional work and studies that would then lead into our updated feasibility study. We're doing some optimization planning right now of potential any scope changes, and our really main goal is to produce the highest quality feasibility study that we can towards the latter half of this year into next year, to be able to be available for project financing and attract all types of capital, including commercial bank capital. And then moving into on a schedule point of view, also looking if there's any ways to accelerate the schedule, which currently with the delay, we're now looking at the end of 25, and if there are any opportunities to optimize that and bring the schedule forward at all. So again, in summary, we have a extremely high grade project. That ability to leverage the cash flows for a strong financing plan in terms of potential streams, royalties, and debt, and a very strong shareholder currently in RCF, and we're looking to advance those activities as mentioned, in particular the early winter road work, with as sources of financing that are as non-dilutive as possible, and today with a market cap of just over 30 million Canadian. Maybe with that, I'll open it up to any questions.
Great. Thank you very much for the great presentation, Rohan. We will now move on to the Q&A portion of the session. We do have a question or two here. First, are the local First Nations now a partner in the project?
So, we've signed, IBAs with the 2 main First Nations. I guess I view them certainly as partners from, how we operated how we go about looking to develop the project. They're not equity partners today, if that was the question. Although, I know there have been equity investments, but in other resource projects, including mining in other parts of the country, and I certainly, welcome that. It's certainly how we view them in terms of, really being side by side partners with, mutual benefit of the project. And I can say, how does that translate? It translates practically speaking in terms of very strong support when it comes to our permitting process in terms of consultation and support letters received from our local communities, and really they're just as eager as any investor to see this project get off the ground, and we certainly are as well.
Great. Second, are there plans to do more, excuse me, are there plans to do more drilling this year to potentially upgrade some of the inferred resource?
So no, thanks for the question. We are right now evaluating, certain, drill programs that may be available, and whether that's focused on, additional studies that lead into the feasibility or additional exploration. We're still evaluating that. I think there is some opportunity potentially for some of that upgrading of the inferreds, or even just bringing it to higher confidence level. I mean, overall, some of the challenges of drilling the inferred resource or beyond even is as was shown in one of the slides. It's a steeply dipping ore body, and the topography goes up, making even a single drill hole pretty expensive the further the further north or further along strike we go. So the question is whether a value cost benefit of the value that would derive for the project, but it is we're evaluating that.
Great. And given the delays in permitting for the winter road, is it possible to look at building an all-season road straight away?
I mean, we are, as when I mentioned that we're looking at ways to rescope and optimize. I mean, sort of everything is on the table, and including ways to shorten the road campaign. The quick answer is no, and even the longer answer is likely no. In that, excuse me, the initial winter trail and clearing that will be done is to open it up to be able to do studies, and the studies even include drilling for geotechnical drilling on that opened surface to be able to finalize the design for an all-season road. I mean, the question it just as I guess an insight is are there ways to go and do some of that testing and drilling with instead of clearing the whole trail with just a helicopter drop of drills. We've analyzed that. At the moment it's not it does not look feasible, but those are things we're still evaluating.
Okay, great. And when now would you expect to start production? And how long after the year-round road is complete?
So really the answer is Q4 25, and we're seeing if we can accelerate that at all. The current plan has the all-around road essentially being complete at the same time as production starts, so that the road is ready for be able to take out concentrate when we start producing concentrate. So we're not completing, the schedule doesn't have a delay in terms of completing the road first and then production later. Everything in the schedule is designed around bringing in equipment on winter roads initially, while we're upgrading the entire access road to an all-season road. And sort of the two align.
Great. All right. Well, I think that's all the questions we have today. Thank you again, Rohan Hazelton, for presenting, and to everyone out there on the line for joining us today. Up next, we have Cordoba Minerals on Stream 1 and Blue Thunder Mining on Stream 2.
Great. Thanks, everyone.